Federal Reserve Chair Jerome Powell announced that the Fed is reconsidering its monetary policy strategy concerning employment and inflation, reflecting on the lessons learned from recent inflationary trends and the potential for more frequent supply shocks. Speaking at a two-day conference, Powell highlighted that the economic environment has significantly evolved since the Fed's 2020 policy framework was established. This framework initially aimed to allow for lower unemployment rates and tolerate higher inflation to counterbalance previous periods of weak inflation. However, the post-pandemic inflation surge and current global economic conditions necessitate a reevaluation of this approach. Powell's remarks suggest that the Fed might undertake substantial revisions to its strategy, particularly regarding its stance on average inflation targeting and the language around employment shortfalls. The current policy, which emerged as a significant shift in 2020, emphasized greater risk-taking to support job growth and tolerated higher inflation levels. However, Powell noted that the idea of a deliberate moderate inflation overshoot has become irrelevant in policy discussions, especially in light of the near double-digit inflation experienced during the pandemic recovery. As the Fed navigates these complex dynamics, market participants will closely monitor any strategic shifts which could impact market sentiment and economic forecasts.
Boeing is reportedly nearing an agreement with the U.S. Department of Justice, DOJ, that would prevent the company from pleading guilty or facing prosecution related to the two fatal crashes of its 737 MAX aircraft. This development follows a previous plea agreement rejected by a judge last year, which stemmed from accusations that Boeing misled regulators about a flight control system implicated in the crashes. The tentative deal, if finalized, would allow Boeing to avoid the negative implications of a felony conviction, which could impact its defense contracting capabilities. The significance of this potential agreement is substantial for Boeing, a major player in both the commercial aviation and defense sectors. Avoiding a guilty plea or trial not only preserves Boeing's reputation, but also safeguards its ability to secure government contracts, crucial for its business operations. Additionally, the agreement may include compensation for the families of the crash victims, addressing some of the legal and ethical concerns surrounding the incident. The resolution of this case is likely to influence Boeing's market position and investor sentiment, as the company continues to recover from the financial and reputational damage caused by the crashes.
President Donald Trump announced plans to unilaterally set tariff rates for U.S. trading partners in the upcoming weeks, citing the administration's limited capacity to negotiate individually with all interested countries. This move comes after a temporary pause on previously announced tariff hikes intended to provide foreign governments time to negotiate. The administration's focus remains on trade discussions with key economies such as Japan, South Korea, India, and the European Union, while also having reached preliminary agreements with the UK and China to temporarily reduce tariffs. The decision to dictate tariffs rather than negotiate individually could have significant implications for global trade dynamics and market sentiment. Tariffs, which are taxes imposed on imported goods, can lead to increased costs for U.S. consumers and businesses, as these costs are often passed down the supply chain. The approach reflects a strategic shift towards more aggressive trade policies, potentially straining international relations and impacting global markets. As the administration moves forward, the financial markets and businesses will closely monitor the developments, particularly in light of ongoing negotiations and the potential for retaliatory measures from affected countries.
Anthropic has secured a $2.5 billion revolving credit facility, underscoring Wall Street's continued investment in the burgeoning AI sector. This 5-year credit line, backed by major financial institutions, including Morgan Stanley, Barclays, and JP Morgan, will bolster Anthropic's liquidity as it competes in the rapidly expanding artificial intelligence industry. The company, valued at $61.5 billion following its latest funding round, plans to use the credit to strengthen its balance sheet and support its aggressive growth strategy. Anthropic, founded by former OpenAI executives, has seen its annualized revenue double to $2 billion in Q1, with a significant increase in high-spending customers. The move highlights the intensifying race among tech companies to dominate the generative AI market, which is projected to generate over $1 trillion in revenue within the next decade. Anthropic's strategy mirrors that of OpenAI, which secured a $4 billion credit line last October to enhance its financial flexibility. These financial maneuvers reflect the industry's focus on scaling operations and developing innovative AI products, as companies like Google, Amazon, and Perplexity also vie for market leadership. The substantial backing from global financial institutions signals confidence in Anthropic's business model and the broader potential of AI technologies.
Asian markets are closing a strong week on a softer note due to waning optimism from U.S.-China trade negotiations. The MSCI Asia-Pacific Index outside Japan is set to rise over 3% for the week, with Goldman Sachs revising its 12-month forecast for the index from 620 to 660, indicating increased confidence in the region's economic outlook. However, Hong Kong's Hang Seng Index dropped by 0.6%, driven by a significant decline in Alibaba's shares following disappointing quarterly revenue. Japan's Nikkei remains stable amid concerns over economic contraction and U.S. trade policies, with the Bank of Japan maintaining a cautious stance on interest rate hikes, possibly delaying any increase until later in the year. In the U.S., bond markets experienced a relief rally as weaker-than-expected core retail sales and producer price data heightened expectations for Federal Reserve interest rate cuts, with a 56 basis point reduction anticipated this year. This has led to a decline in U.S. Treasury yields, with the 10-year yield falling to 4.422%. Fed Chair Jerome Powell highlighted the need to reassess the central bank's approach to employment and inflation metrics. Concurrently, oil prices stabilized after a sharp decline linked to potential U.S.-Iran nuclear deal developments, while gold prices fell after a recent surge. Asian currencies, led by the Indonesian rupiah, rallied on the back of weak U.S. economic data and the prospect of further Fed rate cuts. The rupiah appreciated by up to 0.7% against the dollar, benefiting from improved sentiment in Indonesia's stock market and expectations of a pro-growth monetary policy. The Malaysian ringgit and Philippine peso also gained, driven by the broader retreat of the U.S. dollar and declining Treasury yields. The U.S. dollar index remained flat at 100.56 points, despite an initial boost from the U.S.-China trade truce. The MSCI Emerging Market Currency Index is poised for its fifth consecutive weekly gain, while the MSCI Emerging Asian Equities gauge dipped slightly, but is on track for a weekly advance, reflecting easing trade tensions and economic optimism. Overall, market sentiment remains cautious as investors navigate ongoing trade uncertainties and potential economic shifts.
Tesla and Alphabet are leading a recovery in the Magnificent Seven group of influential tech stocks, following a downturn in the previous session. The group, which also includes Nvidia, saw a decline over 1% on Thursday, ending a 5-session winning streak. However, U.S. stock futures indicate a positive trend, with Tesla shares rising by 0.9% and Alphabet and Nvidia each gaining 0.7%. Despite these gains, the index tracking these stocks has fallen 4.8% year to date. The recent uptick in tech stocks is largely driven by a series of AI-related deals announced during former President Donald Trump's Middle East tour. This development suggests a renewed investor confidence in the tech sector's growth potential, particularly in AI innovation. The recovery of the Magnificent Seven may signal a broader market rebound, although investors remain cautious following recent volatility. This trend underscores the tech sector's resilience and its critical role in driving market sentiment.
Compass Diversified Holdings, CODI, is currently embroiled in a class action lawsuit filed by Robbins Geller Rudman and Dowd LLP, alleging violations of the Securities Exchange Act of 1934. The lawsuit claims that Compass Diversified and its executives made false or misleading statements regarding the financial practices of its subsidiary, Lugano Holdings, Inc., leading to materially misstated financial results for fiscal 2024. These issues include violations of accounting rules and internal control failures. The lawsuit is filed in the Central District of California and pertains to investors who purchased CODI's publicly traded securities between May 1, 2024 and May 7, 2025. The situation escalated when Compass Diversified announced on May 7, 2025, that it had discovered significant accounting and inventory irregularities within Lugano Holdings, prompting a restatement of its 2024 financial results. This revelation triggered a substantial 62% decline in Compass Diversified's stock price, leading the company to declare its 2024 financial statements unreliable and delay its first quarter 2025 Form 10-Q filing. The legal action underscores the importance of robust internal controls and transparent financial reporting, as failures in these areas can result in severe legal and financial consequences. Investors with substantial losses have the opportunity to seek a lead plaintiff position in the class action lawsuit by July 8, 2025, a role that could significantly influence the proceedings and outcome of the case.
TPG, a global alternative asset management firm, has announced a definitive agreement to acquire AvidXchange Holdings, Inc., a leader in accounts payable automation software, for $2.2 billion. The acquisition, in partnership with Corpay, a global corporate payments leader, will see AvidXchange shareholders receive $10 per share in cash, representing a 22% premium over the company's recent closing price. This strategic move will transition AvidXchange to a private entity, allowing it greater flexibility to invest in growth and enhance its payment solutions, thereby improving efficiency and control for its customers. This acquisition is significant as it underscores the growing importance of automation in financial processes, particularly in accounts payable. TPG's investment highlights the potential for businesses to enhance efficiency and security through automated solutions. The deal, which has received unanimous approval from AvidXchange's independent board members, is anticipated to close in the fourth quarter of 2025, pending customary approvals. The transaction aligns with TPG and Corpay's strategic focus on expanding their footprint in the financial technology sector, providing AvidXchange with the resources to scale its platform and innovate further in the AP automation space.
Chime, a prominent fintech company, has filed for an initial public offering (IPO), marking a significant moment for the fintech industry, which has seen a lull in IPO activity since 2021. This move is perceived as a litmus test for the market's appetite for fintech investments, especially given the sharp decline in venture capital exit values from $222.4 billion in 2021 to $29.1 billion over the following years. Chime's financial performance, with a 32% year-over-year revenue growth in Q1 2025 and a shift towards profitability, underscores its readiness for public markets. Analysts value Chime between $15 billion and $20 billion, down from a $25 billion valuation in 2021, reflecting both market corrections and evolving investor expectations. The IPO is seen as a potential catalyst for other fintechs and tech companies considering public offerings. According to Greg Martin of Rainmaker Securities, Chime's move could signal a reopening of the IPO market for profitable tech firms, shifting investor focus from high-growth, high-burn models to those demonstrating sustainable profitability. However, market experts like Samuel Kerr of Merger Market caution against overestimating the IPO's impact, citing economic uncertainties, including trade policy shifts and potential import tariffs, which could dampen investor enthusiasm. Chime's business model and its strong domestic consumer base, with 8.6 million active members, position it uniquely compared to other fintechs like Klarna, which face additional challenges due to international exposure and different business models. Paul Davis, CEO of Bank Slate, emphasizes the importance of Chime's digital-first approach and its role as a primary financial account for many users, highlighting a shift in consumer banking preferences. This IPO not only tests market conditions, but also serves as a strategic blueprint for traditional banks to innovate and adapt their technology strategies in response to evolving digital banking trends.
The main financial event discussed is the rise of Bitcoin treasury companies, with Strategy MSTR leading the segment by purchasing large quantities of Bitcoin. Over the past 12 months, Strategy's stock has surged by 230%, significantly outperforming Bitcoin's 67% return. Bitcoin treasury companies like Strategy issue debt and new shares to finance Bitcoin purchases, leveraging the potential appreciation of Bitcoin's value. This strategy can result in greater returns compared to directly holding Bitcoin, as seen with Strategy's robust stock performance. However, this approach also amplifies risks, particularly during Bitcoin's price dips, where the leveraged nature can magnify losses. The key entities involved are Bitcoin treasury companies, with Strategy being a prominent example. These companies' business model involves using leverage to enhance returns, akin to buying Bitcoin with borrowed funds. This model can provide tax advantages and balance sheet engineering, though these claims lack substantial evidence. The potential impact of this trend is significant. While offering higher returns, it introduces risks not present in direct Bitcoin ownership or ETFs. Investors face potential forced sales of Bitcoin holdings by the company, and the lack of a clear competitive advantage among these companies adds uncertainty to investment decisions. For investors, the allure of Bitcoin treasury companies lies in their ability to outperform Bitcoin through leverage. However, the risks associated with equity-based leverage, potential forced sales, and the absence of distinct competitive advantages make these investments precarious. While the sector's outperformance might appeal to some, the lack of an economic moat and the nascent stage of these businesses suggest caution. The investment landscape could evolve, but for now, the risks might outweigh the potential rewards, making direct Bitcoin investment or ETFs a safer alternative for many.